Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better your investment portfolio. As always, we continue to watch and monitor the situation unwinding in the U.S. and in the world economy closely. As you probably have heard, S&P Standard & Poor's downgraded, or looking at downgrading really the U.S. debt situation a notch, and basically gave a prelim warning to that. Now, this is pretty much old news, and this goes back to my 26 years experience in this business, where you look at these rating agency firms. Their ratings are about as worthless as things get. They're basically usually a day late and a dollar short. In S&P scenario, they're really about 3 or 4 years late and a lot of dollars short, in my personal opinion. But this is true for a lot of the brokerage houses. The calls they make often are slanted, are old, outdated, and basically really aren't relevant in today's times. I mean, who hasn't realized that the U.S. has probably the most amount of debt per GDP capita of any world, whether it's emerging or developed? Bottom line is this: the U.S. has to get its house in order long term in order for the U.S. to continue to prosper, grow the GDP at a reasonable rate of at least 3% in order to basically create good quality jobs here. And also, obviously, the world needs to do the same thing. I think when we look at these downgrades, we take those with a grain of salt, knee-jerk reaction to the market, and we basically really did nothing when those calls really started to come out on Monday. Right now, we are looking at adding positions in some of our precious metals, and really continue to look at our commodity exposure. I think so many investors today are really wondering, well, what's going on in this economy? We look at two different scenarios, not only in the U.S. economy, but in the world economy. One is a cyclical cycle, which is short-term cycles, usually between 1 and 3 years, and secular cycles, which are long-term cycles, which usually will represent 4 or 5 years up to 30 years in length. The last really secular market we had on the upside, or a bull market, really kind of ended in 2000 and really went from 82 to 2000. And really where we've been now is in a secular decline market over the last really about 16 to 18 years. And I already see that continuing for over about a 16 to 18 year period of time, and we've really seen it now for about 11 years. We've seen successively lower lows in some of the markets, especially in the U.S. market. And this where it bodes, where investors need to really realize that what does not bode well is basically a buy and hold strategy. And I see so many investors that are working either with a brokerage house or a so-called advisor that are finally starting to realize, after our educational, not only videos, but my radio show, that most of these so-called advisors are really just acting as brokers. Now, unless you're dealing with a registered investment advisor in a money manager capacity, and that would mean the only way that you would be with a registered investment advisor is if you actually sign a registered investment advisor agreement that specifically stated what their rules, their goals were, and what their services really offered, then you're not dealing with a money manager at all. You really need to understand what the roles of that so-called broker advisor is. And typically it's to sell you products their firms represent, and basically it's a buy and hold strategy. And at the end of the day, the person that sold you those products really is not watching that any closer than you are. So once you start to realize that you either have a real registered investment advisor in a money manager capacity, anything else, in my opinion, is basically sales of investment products without investment strategy. Buy and hold is a dead strategy. It works extremely well when you're in a secular, again, long-term, rising economy or falling economy, depending which way you are playing the fence, whether you're long or short, obviously, in a declining economy or market. If you are making appropriate changes in your portfolio and you realize that this cyclical, which again is short-term in nature, V-shaped recovery we've seen off the market lows back in 2008, 2009 from the credit debacle, what you're going to start to realize is you need to start really emphasizing risk management within that portfolio. We are going to get to a day, and it may be today, it may be next month or 3 months from now, but we will get to a point where this economy will start to flatten out and roll over, and we will go into another recessionary environment. When that basically happens, that's when you're going to be glad that you actually had active investment management and you are making changes to your portfolio. And a big part of that's going to be risk management, especially in a down market. So what I would tell you is this. Defensively, I do like the precious metals, and I especially like the commodity side. Inflation is coming back, as I made a comment many videos ago and also on my radio show. I don't see hyperinflation like Jimmy Carter days, but 4 to 6% inflation will definitely put a damper on the U.S. economy especially, and in my opinion will put a damper on large cap stocks, primarily stocks in the S&P. Now we are starting to see some of the earnings reports that are coming out for this quarter, and they're actually pretty decent for the first quarter. What I would be more concerned about is as we get into the third and fourth quarter this year, comparisons are going to be much tougher. We have maximum, in my opinion, maximum margins on most corporations. When you have the size of the margin extreme that we have on earnings and profitability in corporations, that's usually when you start to see a possible slowdown. Now, I see that again in the third and fourth quarter of this year, and that's where really we're going to be emphasizing the caution signals. We are watching things closely every single day. And as always, I hope this instructional update was good for you. Don't forget to listen this Sunday to my show from 10 to noon on radio stations near you. And as always, if you have a question about your portfolio, you can send us an email. I'll be more than happy to answer that on the radio show, the Resnick Wealth Report. And if you'd like to come in and talk to us about managing your portfolio, if you're realizing that the person you have really is not acting in a money manager capacity really at all, there's a lot of conflicts of interest. Maybe you've been sold an annuity, 2 or 3. Unfortunately, that happens to investors. Or you're finding that person really isn't watching your money any closer than you are, and you want professional, fee-only money management without the conflicts of Wall Street. Give us a call. We'd love to sit down with you, review your portfolio, and help you get back on track. Until Sunday's show, make sure you have yourself an extremely profitable day.